Hi, everyone, and welcome back to another episode of Unlocking Venture Capital. I'm here today with Jeff Becker. How are you, Jeff?
I'm good, thanks. I appreciate you having me on.
Yes, thank you so much for coming. And so, Jeff is the GP at Antler in New York. So, would love to learn more about Antler today and about how you guys are working with founders in a way that's very different than traditional VCs and traditional accelerators. So, Jeff, can you give us a bit of an overview with how many portfolio companies you guys are currently working with in this cohort, and how you guys work within the VC ecosystem here in New York?
Yeah, for sure. So essentially, we think there are three things that have stopped great people from starting companies. The first is essentially finding a co-founder, right? Like, where do you find a technical counterpart? Where do you find someone who can help you with distribution? The second is around culture. It's really lonely to build a company. And so, where
Yeah.
do you find ambitious people to work alongside and spend time with? Put in those 8 a.m. to 2 a.m. days for the first year or two that you're building, maybe even longer. And then the third is friends and family money. So where do you go to get your first 500K? I think what people don't realize is that there's a lot of hidden years of inception stage
Mhm.
for companies. What I mean by that is the average accelerator company is about 14 months old. They tend to have 2 to 3 employees. Users revenue tends to be in the 50 to 100K range. And so if you look at that, it's a bit broken. Like, what do you do in those hidden years of inception? What do you do in the first 12 to 14 months? And what Antler is doing is reverse engineering that. We're creating an opportunity for people to come together without giving up any equity in their company, to work alongside the most ambitious people we can find and create that culture at day zero, do the co-founder matching. And then at the end of that program, at the end of 8 weeks, we have the opportunity to invest in the absolute best people and give them that first 500K. So we found a lot of what I think is product market fit in that offering. We have 160,000 people who apply every single year to build a company at one of our 30 locations around the world. We've built that to a billion under management in just under 7 years, and we've backed 1,300 companies so far. So, it's early days, especially for venture, where, our average company in the United States is under 2 years old. And
Mhm.
it's about 2.1, 2.3 years to get to a price seed round. So I think you're going to see a lot of headlines from the Antler portfolio over the next, 12 to 24 months for sure.
And that's really exciting. And also, because you guys are generalists in the sectors in which you invest in, would love to learn about, some of these different sectors that you had to learn about, some of the new things that are coming up, and what are you seeing today that you haven't seen maybe when you first started at Antler or as an investor?
Yeah, I think importantly in the model and the way in which we invest, where it's purely based on the founder and their execution rather than the idea in the market, it's actually quite important to decouple from the emotion that comes with thinking things are good ideas or that markets are interesting. I learned so much from our founders. We find, well, for example, this year we'll have about 17,000 people apply just to the US program.
Wow.
And we'll admit only 3% of those people will get in. These are top 1% people in their fields, people that have spent, 10,000 hours in, all kinds of different sectors and domains. And they come with real institutional knowledge about what it is that needs to change in those industries, things that, I would never know from an outside looking in. And so what we try to do is get very, very good at underwriting people's commitment, execution, bias toward action, first principles thinking, just really the level of commitment and clarity of thinking, along with the ability to build and sell, and really underwrite that in addition to, hey, look, this is a top 1% person at, you name the industry.
Yeah.
And by decoupling from that, you can really remain unemotional and back the best people, as opposed to, I think, sometimes when we try to crystal ball things, we might back a team that isn't really as committed as they should be because the idea market's amazing. And I
Mhm.
think that's always a mistake because ideas are a dime a dozen, but execution is really what ends up winning out.
And I think that, you touch on a really great point that a lot of VCs say, but it's really difficult to execute, which is that you try and figure out who the founder is and what they're working on and why they're motivated to do what they do, right? Because in
Yeah.
day in and day out, it is really hard to keep burning that midnight oil for, like you said, X number of years before you're get to your pre-seed or your seed. And that
Yeah.
takes such a toll. And so, having said that, yeah, I know that you guys have these really interesting programs where you add on matching to the funding rounds that they're doing, and so you have to be really careful about which ones you're choosing and things like that. So, are
Mhm.
there different kinds of criteria that you guys have as investors when it comes to that point, whether it's funding or matching or other programs that certain kinds of founders are more of a fit for versus others?
When it comes to follow-on investing, you mean
Yeah.
specifically? Well, in the US, we're testing something called the Agreement for Rolling Capital.
Mm.
It's a new type of safe that we invented that I worked with our lawyers to come up with. And essentially, what it says is I'll commit $300,000 to your company in a follow on basis. But the way that you get that money is we'll match 50% of whatever you raise externally. So for the founders, it acts as a catalyst to their future rounds. And then for my LPs, it acts as the ability to put more money to work in the companies that are succeeding out in the market with VCs who are underwriting the ideas, the markets, the competitive landscape, and so on. And I think that's really important, right? When you're developing a fund, you're creating any kind of product, you want to look at the incentives, you want to look at the customers. In my mind, as a VC, my customers are the founders and it's the LPs. And we have to do things that are good for both of them, not one at the exclusion of the other.
Yes.
You don't want to be creating programs that are predatory on a dilution basis to founders, and you don't want to be putting money to work from your LPs that's not going to return capital. And so, in this particular example of the agreement for rolling capital, we're really catalyzing the round for the founders at a time when it's tough to raise. Actually, in New York, I've done 21 investments this year. 18 of them have already raised additional capital using the agreement for rolling capital. So we're
Wow.
seeing about an 85% fund through rate. And the three that have not raised are actually doing amazing in terms of revenue and just don't need to. So
Yes.
I'm feeling quite good about that and the impact that that has had. And our LPs are, very excited about it. I think it's amazing to be able to put more money to work in companies that are, getting marked up, 3 to 5x on average within 3 months of coming through the residency.
And to that point, because as you know, VCs are branded as these innovators. You're searching for the innovation you want to be in first, and yet a lot of VCs, most VCs, do not go into a round if you don't already have somebody in, which is
Mm-hmm.
something that founders have a hard time adjusting to, especially if they're fundraising for the first time, because they're
Yeah,
like, well, why do I need to already have someone in for you to come in? That doesn't make any
yeah,
sense. Shouldn't you be doing
yeah.
your own, opinions? Shouldn't you be doing your own due diligence and all of those things? But having, Antler in as they're already in, if you guys come in for this amount,
Yeah.
means so much to a round. And I think that it's weighing even more importance in today's market than ever before.
I think so, but I also think that our best founders are prioritizing momentum in the round rather than looking for a lead. And so it's
Yeah.
very common today. I just wrote about this on Monday morning meeting, but this new kind of advisory board where you have founders who are stacking 10, 20, 50, 100 advisors on their business, which may sound crazy,
That
but
is
they're doing so with 200 shares at a time as opposed
okay.
to a quarter point of equity. So they're
Right.
building this WhatsApp group or Telegram group where you have, you know, 25 to 50 people who each have, call it 1,000 shares on average, 25 to 50,000 shares of a company. That's only a quarter point to a half a point total when it comes to 10 million outstanding. So the same amount of equity you used to give to one advisor is now being split across 25 to 50. And they're
Mm.
giving these people the opportunity to invest in their company, the opportunity to run free pilots and proofs of concept, the ability to gain more equity in the business by referring customers and referring investors. And so when you operationalize a group like this, people who are particularly well vetted in the industry, that can become angel investors, that can become customers, it's actually this like force multiplier in execution before there is a lead investor. And what I found in my companies that have done this, they've raised anywhere from a quarter million to $1 million just from that advisor group. That
Mm.
advisor group has then become customers and generated revenue. And then when you go out to actually fundraise, you say, look, this round has already been coming together. I've got expert A, B, and C who are invested in the business. They've become customer 1, 2, and 3. And then when you go into that round with that venture capitalist, it's less about like, hey, why won't you lead? It's more about, hey, I've already got the momentum. Someone is going to lead. Do you want to be that person, or are you going to let it pass you by? And that sort of dynamic is really become more prevalent in my best founders.
I think that that's really important to note too, because at the end of the day, it is about the founders that are building these businesses. You can have hundreds or thousands of venture capitalists in one city and have no founders. That's completely useless. And
Yeah.
so why not have that? And I think that that's really great. Is that something that came up because of an initiative that you guys were bringing forth in your cohorts, or was that something that the market naturally gravitated towards that you just happened to be seeing within your founders?
No, I've been part of this one advisory group for a while. The founder is a very interesting guy and a very unique thinker. The business is doing amazing. I can't talk too much about the valuation, but it's grown to, I guess that's like nine figures now, and mid nine figures. Pretty amazing. And his advisor group is a lot of people,
Oh,
and we're all incentivized by very small amounts of equity. The valuation based vesting is interesting. He only gives us additional equity as the valuation grows, so we're all aligned on where it's going rather than a time based vesting period. And so I started telling some of my founders about this, and some of them took to it, some of them didn't. But the ones who did, most notably, a company like Dune Security has built an amazing CISO council and advisory board. They just closed on a very impressive seed round that they'll announce soon, I think, which is great. And they've got 80 CISOs on their advisory council. I look at some other portfolio companies like Agentio. That's an amazing group of people that are surrounded by him. Obviously, being the former founder of Cameo, he's got some amazing track record there. But the people in this group are outstanding individuals that are all there to help and help the business grow and provide feedback. And it's really been a force multiplier. The same is true in Hi-Fi Bridge. They're doing an outstanding job. That company's revenue is going through an absolute S curve right now.
mhm.
And I think a lot of it goes back to founders who surround themselves with exceptional people, hold them accountable, provide opportunities, know the value of their business. And that kind of energy and effort actually attracts people. Whereas, it used to be, give an advisor a quarter point to use their name on your deck. It's really become the opposite, which is, I believe in what I'm building. And if you want to be part of it, you have to invest. You have to put your money where your mouth is, your relationships where your promises are. And I think that some of the best companies just naturally do that. So the more cycles I've seen, the more pattern recognition I've had, and I think you're starting to see that come to fruition in a lot of these great companies.
Yeah, and there is no risk in helping. That's the whole point. And I really love that kind of mentality because it gives you that mentality of abundance, which is what founders really need during these
Yeah,
stages. Absolutely.
yeah.
So for everyday people or business leaders, thought leaders, and angel investors, how can everyday people get involved with these initiatives? What kind of plugin would you have for our audience?
Yeah. Well, I guess for Antler, the number one thing is we host an Ask Me Anything, an AMA every week. And we do that for people that are still working at their jobs. Like if you think about this, accelerators are rampant, they're everywhere. So if you have
Yeah.
a product, you've got users, you've got a team, you've got revenue, there's accelerators, there's pre-seed funds, you have something to underwrite. Like the market has already built all of those muscles and all of those motions for those people. But what doesn't exist or what does now exist with Antler is the ability to learn about what it's like to start a company before you ever leave your job. So
Yeah.
what is it, coming to an AMA, signing up for one of those is always a great first step. Referring people that are thinking about building companies, that's a great step. I think what you'll find is that when you have 20,000 people applying and you only admit the top 3%, the room becomes filled with exceptional people. And those are the kind of rooms you want to be in. You want to
Yeah.
be around people that, are second time, third time founders. I have people that have exited their businesses for 100, 200 million. One guy in the last cohort exited for 500 million. That's about 40% of the room. The other 60% of the room are first time founders, domain experts, technologists, real experts in various fields. And I think that if you can optimize for culture in the very, very beginning of your business, you can surround yourself with great people, build a motion of hard work every single day, be exposed to the type of commitment that is required to build an iconic company. You just give yourself a much better chance. I think
Yes.
95% of founders do it on their own, do it lonely, the lonely version rather, and entropy sets in. It compounds to zero just because it's hard and exhausting. But when you're around other people and you're in the office in person, hopefully you can compound exponentially instead of the other direction.
No, absolutely. And do you think that over time your cohorts are going to get bigger and bigger?
Well, you got to think about this. There are funds that are growing and becoming bigger and bigger right now.
Yes.
It's pretty common.
Yeah, but having
Um,
the fund is very different when they're growing bigger and bigger versus what you guys
yeah,
are doing. You need to have a physical space as well as the funding, as well as the
yeah.
manpower. There's so much
There's
support
um
Sandler provides.
there's a bit of Dunbar's law here. Like my current cohort's around 130 people. I don't want to crack through 150 because I feel like it's just too hard to get to know everybody. It's too hard to get
Yeah.
close with the founders, too hard to underwrite those businesses. So for now, at least 130 is still very manageable, at least with, one partner, two associate partners, and a couple of principals
Hmm.
helping out. So maybe we grow the team to grow bigger in size. But I think for now, it's important, especially in venture. Bill Gurley says the best way to be successful in venture is to be successful in venture. And it's a funny statement, but it's true. Like past performance in VC does generate additional momentum in your flywheel in terms of who will work with you,
Yeah.
what referrals you get. And
Yeah.
so for me, we're only 3 years in the US. It's very important to me that we make high conviction, exceptional bets early, that our track record becomes apparent, that the quality of our deal flow and the quality of our founders is what we lead with in these early years in the US. And, through years 3, 4, 5, 6, I think it makes sense to keep the cohorts at this size, get denser and denser in terms of talent, and make more investments per cohort by a function of the quality of the group, but not grow the overall size too much. So I think investment pace will continue to go up, but I don't imagine cohort size going up. I think that we'll just get greater density and higher selectivity on applications. And then, as we get into fund two and fund three here, which will launch shortly, and I'm excited about, I think then we'll start to see additional investments in infrastructure and office space expansion across the US. But it is really important to me that we have those early winners and can demonstrate not
Yeah.
only to the founders, but also to the downstream investors that we are producing, what I call maniacs, like producing real high conviction, 0 days off, fully ambitious, fully dedicated, real experts in their space and creating something of real value.
Hmm. And I think that bodes well to the kinds of founders that are graduating from these cohorts. One thing that I have seen, I would love to get your take on this, is I went to a digital event to help out in an accelerator, and there were people who have already come from at least two or three accelerators to apply for their fourth accelerator,
Yeah.
and I was like, I didn't know that that was possible. That's more accelerators
Yeah.
than we have in the whole country. So is that something that you are also seeing coming through your door now more than before? And why do you think that's happening? What's your take
Yeah. Um, I think if you're a solo founder,
on?
there may be a case to do two, meaning you go to something like Antler where it's like, I have no idea, I have no co-founder. Let me find someone, we work with someone. You don't find someone, but you do build something in meaning, you do get a check. Then going to something like a YC where the average company is a year old or longer, that
Mm,
can make sense, right? You're only giving up another 9%, including the MFN. It's less expensive than a co-founder. It's enough cash, our investment and theirs together to last for a couple of years. I've seen people do that and have it be successful, but it's definitely the minority of founders. If you are fully self-reliant, incredibly ambitious, you have the ability to build and to sell and attract people around your vision and find customers, you shouldn't need more than one accelerator, like you really shouldn't. I think if someone has done two or more than that, it starts to become a negative signal. Um, and specifically not just for the reasons of like able to fundraise and able to get progress, but um, if you think about it, like a lot of the accelerators, and there are many, right? They're all over the place. A lot of them are programs. A lot of them are there to teach you how to build a company.
yeah.
And when it comes to Antler, I've designed it the opposite, where it's actually choose your own adventure. We're not teaching how to build a company. We're actually leaving it up to you in a room of 130 ambitious people to social sort yourselves and be self-reliant and build things and work together. And we get some asymmetric information there and how people act and operate. And of course, we have programming. We'll bring in the founders of Superhuman and Venmo and other things to do talks. So there is some programming, but I tell the founders, like, if this is not building or selling, if it doesn't add value to your company, like, don't worry about it. And so um, I think if they've done a lot of accelerators, they might be there for the learning and the teaching and the programming, which would be a red flag because ultimately you want people that are self-reliant, that are autodidacts, that make things happen and overcome challenges, rather than sort of look to others to help them understand, how do I go to market, what should I be doing. That is sort of a very slow and hard process, and you're actually paying for the learning curve as an investor as opposed to paying for the, self-reliance and momentum of a venture-backed company.
That's so interesting that you are putting weight of emotion as well as finance on what they are really expensing, what they're really paying for as a founder. And I think that that's a really good way to look at it because not enough people value things. They would overvalue the things they don't have or the things
Yeah,
that they don't have, right? And
yeah,
that would be like so highly overvalued to compare to what they do have. And so I think that you bring up a really, really good point. Another thing that I also noticed when I came to visit your
yeah,
establishment was that when these prolific CEOs came, these 2 or 3 time exited CEOs came to do the talks, a very common question, which I thought was very funny because everyone is in
yeah,
a different industry, but they
yeah,
have a lot of questions surrounding go-to-market strategy. And I
yeah,
was like, but wouldn't you be in the same kind of thing to ask these kinds of questions? And it was really interesting that they were very detailed in their questions in order for him to be able to answer. And
yeah,
so would love to kind of see what the commonalities are that you've seen because these questions have been asked to you
yeah,
150 times. Um,
yeah.
and what kind of commonalities there are, even though they're from different industries.
Yeah, I think I led sales teams at LinkedIn for 9 years. So I was always a B2B sales guy. And coming into venture, I naturally just that was who I was and the approach I took. And so, you know, classic like Sandler pain funnel discovery, sort of like customer value type of approach. But as I've been in venture capital for a few years now, and I've seen different types of businesses and different types of founders, I
Hmm.
think you first have to figure out what kind of company am I? Like, product led, tops down, consumer. Like, what am I? Who am I? What do I want to be? And then the second is what kind of founder am I? What are my
Yeah.
strengths? Where are my distribution advantages? Where are my strengths? And trying to play to the overlap of those two things. When we had the founder Superhuman, Vivek, Rahul's co-founder, and talked a lot about product market fit and product led growth and how to measure it and the engine that they built for that strategy. I thought that was fascinating. And I've probably told that story 100 times. I wrote about it in my book, Inevitable, as well. And yet, still, so few people pick up that exact strategy and operate it the way they did, even though the playbook is completely filled out. And so
Mm.
it's really interesting that here there is a step-by-step approach, and very few people actually use it. And
Yeah.
then you have, my B2B founders, and I can teach B2B sales all day long, and people really do gravitate towards that stuff. But there's a very small percentage that actually uh, take it the distance. I have a company like Valley, for example, joinvalley.co. Um, they're outstanding. And when I do a sales session with them, it's like everything is not only internalized, but then he builds content and product out of it. And it'll be 10 times better than I ever articulated it. And so if you follow Zaid, the founder there on
That's
LinkedIn,
funny.
and you read his posts, like, he is very dialed in on B2B sales. It's a very
Yeah.
different approach. Um, whereas I've had founders that have to pivot through, do I do an SMB product led strategy or a tops down enterprise strategy? And so I think like these playbooks are pretty well defined, but I think what founders fail to do is actually reflect on what are they best in the world at? What is their
Right.
team best in the world at? Where are their distribution advantages? And what does the product require? If you're building a product led growth business, you better be really, really good at product led growth. You better be very good at product market fit. You better have a scientific approach to hypothesis testing and to product market fit measurement. And I would say 99% of people that are attempting that really don't. So again, it's interesting to hear the different answers to those speakers. But what I've
Hmm.
noticed is that it comes down to some of those dimensions rather than there being a one size fits all.
That is so interesting. Yeah, and because the speaker doesn't have enough time to really dive into your business model specifically, I am very fascinated with how they are able to answer all of these questions in such a diverse room. And
Yeah,
so, I really love that approach, and I really love what you're doing, and I hope you keep it up. So.
yeah.
Thank you so
Thank
much,
you.
Jeff. I think that what you're doing is great. I think that what your initiatives are that you're putting out into the industry is right on trend and at the right timing of the market as well. And I think that other co-investors are responding to it and responding to the quality that's coming out of your cohorts.
I appreciate that. Yeah, I was excited this month. We've gotten deals done, a couple deals with Andreessen and a deal with Kraft, Ensemble, with Signal Fire. We've done some really cool deals, and they'll start to get announced here on LinkedIn in the coming months as everything gets solidified and all figured out with the founders and the press and all that sort of stuff. But it is really great to see that maturity in the portfolio. I'm very excited for my founders. I think when you ride shotgun with them and you exchange 100 texts a day, or you spend your nights and weekends with them, and you see how hard they're working and what it takes to get to these moments. It's exciting when it happens, but the very next day it's back to work. Like, how do we deploy the money? How do we think about doing this efficiently? How do we grow into the next phase of growth? And hopefully we're choosing the right partners to help them in that, the same way Antler's helping them from 0 to 1. It's really important to get around the right people from 1 to N. And I'm really excited about some of the progress lately, but yeah, hopefully people will tune in and see those updates as we share them.
Yeah, absolutely. And they'll tune in to see these updates as well. So thank you so much
Amazing.
for coming on to the episode, Jeff. So thank
Yeah.
you everyone for coming on to another episode of Unlocking Venture Capital. I'm here with Jeff Becker.
Thanks so much, Sydney.